Good morning, everyone. This is Unit 3, that is Financial Markets in Investment Management. Introduction. Financial market is a place where funds are raised against the issue of instruments or securities. Here, it is a marketplace where the amount can be raised against the issue of instruments or securities. Instruments or securities are nothing but the financial instruments like the shares, the debentures, or bonds. I can say it is a platform where the person who has money can lend it and the person who is in need of money can borrow it. Okay, so here divergent needs are present in each and every person. So one person, he has the money, but he doesn't have the idea or the project to invest that money, and the other person who is in need of money and he has the project in his hands but he doesn't have the money, then this will be the platform where the two persons they can exchange and they can perform the operations, and this can be helpful for the development of their individual goals. So here these instruments or securities are called as financial assets. These instruments, these are called as financial assets because as these are invested, the amount is raised against the business operations for divergent needs or for diversifications or for expanding the business, and in return they are going to get some benefits, financial benefits. So that's why these are called as financial assets. Next, meaning and definition of financial market. So various scholars have given the different definitions. We'll see one by one. Ligories defines a financial market as an organized institutional structure or mechanism for creating and exchanging financial assets. So this we have already discussed how the creation and exchange of financial assets will be done by various participants of the market. BusinessDictionary.com defines financial market as markets for sale and purchase of stocks, bonds, bills of exchange, commodities, futures and options, foreign currency, etc., which work as exchanges for capital and credit. Here, the financial market is defined as markets for sale and purchase of stocks. So here the buying and selling of stocks, bonds, bills of exchange, commodities, futures and options, all these will take place. That is nothing but both the long term and short term securities will be exchanged between the participants. Classification of financial markets. Financial markets are broadly classified into two types. One is capital market and another one is money market. So money market is nothing but it is the place where the borrowers and lenders exchange short-term funds to solve their liquidity needs. So within 1 year, if the funds are being raised and if the needs are being fulfilled, then it is called as money market. Here, banks are the big players in the money market as both as lenders as well as borrowers. So if you take the RBI or commercial banks, then these are the institutions which play a key role for lending as well as for borrowing the money whenever they are in need, and also they will provide the working capital requirements for business and other industries. Coming to the examples of money market, there are these certificate of deposits or treasury bills, or you can go for commercial papers or call money. All these will come under money market. Next, capital market. It is a market for long-term funds. Securities like ordinary shares, preference shares, debentures, bonds, and long-term loans comprise the capital market. So capital market is for long term, that is more than 1 year. Examples of capital market are ordinary shares like equity, preference shares, debentures, bonds, any long-term loans. So all these will come under capital market. Features of money market. First one, market for short-term funds. So it is a market for short-term funds. Here, the instruments taken within the money market are called as near money because they can be converted into cash very quickly without any loss of money and also time. Here, the investors have the money available is only for temporary basis. The borrowers need the money for meeting their day-to-day cash deficit. So mainly the RBI or the commercial banks will be involved in this money market wherein the deficit arising within the market will be fulfilled by other commercial banks or other financial institutions. Next, tenure of instruments. Tenure here is the time period. So here the time period in the money market is from 1 day to 364 days. That is within or less than 1 year. 1 year or less than 1 year. That is the time period. Next, wholesale market. It is a wholesale market, and here only the specified institutions or permitted institutions can participate in the money market. As the individual investors and or household or retail investors will not be able to participate in the market as a lender or as a borrower, only the professionals are allowed to participate in money market. And here the settlement required for the participation of professionals is also very difficult. Only the big institutions like banks and other financial institutions will be able to participate, as the amount lending will be very huge. So here the minimum size of each trade should be 1 crore rupees, and this is not be possible for individual investors to invest or lend or borrow that much of money. So that's why only the professionals or the big institutions like banks will be able to participate in the money market. Next, direct market. The transactions are conducted directly between the borrower and lender. So here the services of brokers or any other intermediaries will not be allowed or will not be used, as the amount is huge, that is it is being dealt in crores of rupees. The brokerage or other intermediate fees will be very high. So that's why only the participant institutions will be able to participate, that is the buyer as well as the seller. And even the participants will be able to fulfill if any legal or technical or financial crisis or financial problems arises, then those will be solved or those will be identified by the market participants. Next, daily settlement. So here the settlement takes place daily, that is the funds are lent for very short periods, that is as minimum to a day to 364 days, as I have said earlier. So usually it is for a day or two. That is, if you take any instruments like commercial papers and certificate of deposits, the transactions are carried out instantly. That means the transactions will be taken immediately. So here it will be on daily basis. Daily settlements will take place. Next, huge volumes. The volume of transactions, that is nothing but the amount, is very huge. For each and every day, the transactions deal will be very high. So here, only the borrowers or only the lenders who are able to, who has high net worth can participate in this particular money market, and the interest rates also fluctuates widely. So the size of the funds needed or um, is very huge, and the cost will also vary. So this is the reason why the interest rates in money markets always fluctuates. So if you take the RBI repo or CRR ratios or repo and reverse repo rates, those will always vary. That is, those will always be getting changed. So due to this particular purpose, due to high demand, the interest rates will be varying. Next, large size transactions. So here the size of each transaction is also high or huge. It is running into crores of rupees, as it is minimum. It starts with 1 crore of rupees. Here the instruments will be or securities are issued for a very high denominations. The transactions values will also be very high. So minimum it is 1 crore. That means the transactions value starts with that particular amount and more than that. So this is the reason why the individual investor will not be able to participate in the money market. Next one, RBI regulation. The money market is regulated by RBI. Here, the RBI itself, it is a participant. It is one of the important participant. It closely checks all the transactions, or it monitors the market, the liquidity crisis, if any, and it tries to develop the market as well as the economy. So it is a big lender as well as a borrower, and as RBI itself is involved, the investors too will feel confident in investing in the money market. Next one, administered interest rates. So the interest rates are not, these are not entirely market driven, but the rates like repo rates, cash reserve ratio of the banks, bank rates, these will have the impact on the money market. And these rates are usually administered by the RBI. So whenever there is, these rates will be used to control the credit in order to correct any monetary imbalance. Like monetary imbalance means if there is any inflation or deflation in the market, then these will be corrected by RBI through these rates. Next, credit control measures. RBI operates more as a credit controller in the money market rather than for any commercial considerations. Like if the rates have to be expanded or if they have to be contracted, the credit rates have to be expanded or contracted during the recession or inflation period. This will be done by the RBI through its credit control measures. Next, telephone market. Here, there will not be the physical presence between the borrower and lender only through the telephone. That is, the communication will be done through telephone, and it will be only for the short term. Through this, the transactions will be taking place by telephone and not direct contact will be done. Next, many players. So there are many players in the money market, right from the central bank of the country, the government, commercial banks, any discount houses, foreign institutional investors, mutual funds, and big corporates who are having additional support or additional surplus, and they'll be able to borrow for their short-term requirements. So these are all about the features of money market.